Hey there, Financial Futures family. Welcome back to the channel, where we dive deep into the financial markets and help you stay ahead of the curve. Today, we're talking about a hot topic that's got the investing world buzzing: calls for the Federal Reserve to do an emergency rate cut to prevent a potential recession or stock market crash. Before we get into the details, make sure to hit that subscribe button and click the notification bell so you never miss an update on the latest market moves. Trust me, you won't want to miss this one. So, let's start with a bit of history. The Federal Reserve has made emergency rate cuts in the past, and these have often come at crucial moments in our economy. I want to take you through a few key instances where the Fed stepped in to cut rates outside of their regular schedule. January 2001, after the tech bubble burst, the Fed made an emergency rate cut of 0.5%. April 2001, a weakening economy led to another 0.5% cut. September 2001, following the tragic 9/11 attacks, the Fed cut rates by 0.5%. August 2007, the housing market crash triggered a 0.5% emergency rate cut. January 2008, amid the stock market crash, the Fed slashed rates by 0.75%. October 2008, as Lehman Brothers collapsed and the financial system teetered, another 0.5% cut was made. March 2020, with the onset of the pandemic, the Fed made an unscheduled cut of 0.5%. Now, here's where it gets interesting. The stock market's response to these emergency rate cuts has been mixed. Sometimes, the market reacts positively, and other times, not so much. But I want to highlight one significant outlier after the 9/11 attacks. The market was closed for 4 trading days, the longest shutdown since the Great Depression. When it reopened, the reaction was understandably volatile. Keep that in mind as we look at the data. So, what does history tell us? Well, the trend shows that when the Fed starts cutting interest rates, the market tends to go down initially. That's not a guarantee, but it's something to keep in mind. You might think that rate cuts and easier monetary policy would immediately drive stock prices up due to financial asset inflation, and over the long run, that's true. But in the short term, it can go either way. The next Federal Reserve meeting is on September 18, and market expectations are shifting dramatically. According to the CME FedWatch tool, there's a 100% chance the Fed will cut rates at this meeting. The only question now is whether it'll be a 0.25% or a 0.5% cut. But that's not all. The market is also pricing in additional rate cuts for November and December, expecting 3 cuts in total by the end of 2024. There's a lot of speculation out there, with prominent figures like Jeremy Siegel from Wharton calling for an even bigger emergency cut of 0.75% right now, and another 0.75% cut in September. He argues that the Fed funds rate should be around 3.5% to 4%, a far cry from the current 5.5%. So why the urgency? Well, the unemployment rate recently hit 4.3%, the highest it's been in 2 years. Given the Fed's dual mandate to manage inflation and ensure stable employment, this spike in unemployment is a big deal. Of course, there's another side to this debate. Some analysts argue that the Fed shouldn't be pressured into an emergency rate cut just because the stock market is shaky. They believe that this recent volatility is simply the market unwinding some positions, not a response to a deeper economic shock. In fact, they see it as a buying opportunity. On the other hand, some fear that an emergency rate cut could actually spark panic rather than calm the markets. The signal it sends might not be the one investors are hoping for. So, what do I think? Personally, I believe the Fed will cut rates in September. While 4.3% unemployment might not seem too high historically, it's already above the Fed's projections, and we're only in early 2024. This suggests that easier monetary policy is on the horizon. But remember, as I showed you earlier, when the Fed cuts rates, the market doesn't always react positively in the short term. Volatility is almost guaranteed, and we need to be prepared for that. And let's not forget about inflation. As the Fed moves towards easier monetary policies, including the possibility of resuming quantitative easing, inflation could become a bigger issue down the line. So, what's next? In my upcoming video, I'll dive deeper into what these rate cuts mean for stock market investors and how you can best position yourself. Make sure you're subscribed and have notifications turned on so you don't miss it. If you found this video helpful, please give it a thumbs up, share it with your fellow investors, and leave a comment below. What do you think the Fed should do? I'd love to hear your thoughts. Thanks for watching, and until next time, stay smart with your investments.